Afternoon, Facebook. Normally it's morning. I had to check myself then. How are we doing? So today we are going to be doing a Facebook Live with a friend of mine who's based in Milton Keynes, and she is a tax expert. In property, you know, we make a lot of money, but it's not really about how much money you can make, it's about how much money you can actually keep, right? So Helen is going to be here for the next kind of half an hour to answer any questions you've got, bust any myths that are I've got a big list of questions that have come already, so I'm going to be asking her those. But yeah, we're going to basically be here to answer any of your questions and go from there. So I'm going to try and bring Helen in. Normally I have a problem when we do this bit, so let me just see if I can bring her in with a little bit more pace than normal. Let's have a little look here. Okay. Helen, are you there? Can you see me? I always have these challenges. Helen is watching. Right, okay. Helen, we're going to add you in. 2 seconds. Add. It's quite smooth, it seems, this morning. This afternoon. Come on, is it going to work? Oh, it says it's adding. She should be coming in.
Ah, there you go.
Yay! Success! Success! How are you?
I'm good, thanks, Sarah. How are you?
Very well, thank you very much. Very well. So I've just done a little brief introduction because basically I think Facebook, it has to run for like 60 seconds or something before you can bring anyone else in. So I just talked for a minute.
Right.
Guys, so just to introduce to anybody who's watching this video now or who's going to be watching the video at a later date, Helen is based in Milton Keynes. I'm going to let her introduce herself in a minute, but we met at a networking event. You guys know I'm an advocate of networking. I think it's really important that you get out and meet more people, and not only because it builds your customer base, but also because it gives you an opportunity to meet people that can add value to your business, you know, experts in their area. And Helen is an expert in the tax area. Helen's worked with some of the big name property investors that we all know and love, and advises on tax efficiency for people like us. So Helen, if you could just introduce yourself. I'm going to go and shut the door because I forgot to shut it on my way in. While you do that, I'll be straight back.
Okay, so yeah, I'm Helen Beaumont from Essendon Tax Consultancy. I'm a chartered tax advisor. I've been advising solely on tax for about 20 years, and specifically property tax since about 2014. And I advise buy-to-let landlords and developers on all aspects of taxation.
Wow. So for me, property tax terrifies me. It's a subject that I don't understand. Accounts are definitely my nemesis, and I know there's a lot of people that feel the same. Is it as scary as we all think it is?
There are, I mean, to me, I don't find it scary. I find it exciting, but that's why I'm doing the job that I do.
Yeah.
I think the problem with tax is the legislation is always changing. And not only have you got the legislation, but you've also got HMRC to deal with, and their practices change. So it's difficult to keep up to date. And, you know, if you weren't sort of doing it full time, then you could very easily miss things. So I can see why people do find it very scary.
Okay, so what would your immediate advice be to somebody like me who's a complete dunce when it comes to tax about staying up to date? Is it really just speak to a professional advisor like you and work with somebody like you, or are there other like tactics that we can use?
I think, I mean, there are speak to an advisor, but also there are a lot of free resources online. So I blog once a week on tax issues, but not always property, but primarily property. And I always try and look at what is most up to date, or things that I've come across during the week that I think might be interesting to people. And there are a lot of other free resources online. So, but as with anything online, make sure you're reading, you know, the most up to date guidance. I was looking at something earlier today and then realised it's from 2012. So, you know, because tax changes so quickly, always make sure that you're reading the most up-to-date information.
Okay, cool. So I've got a list of questions here from the community. So I'm going to just fire these at you, if that's okay. So
that's fine.
The first one, and the one that I get asked about all the time, let's just get it out on the table, which is, should I be buying my houses in a limited company, or should I be buying my houses as a personal person? What is the most tax efficient way to do it? I think I already know your answer to this, but for the community, what's your advice on that?
Yeah, I mean, it does really depend on personal circumstances, is the first thing to say. I mean, just in general, putting aside property, in general, the question of, you know, should you trade in your own name or through a limited company, because of the changes to dividend taxation, it is marginal now, the benefit that you get from a limited company. However, for property investors, when you bring into Section 24, then limited company is generally the more tax efficient investment vehicle. But
oh no, I think we've lost Helen. That's no good. Helen, are you still online? I think maybe your signal's dropped out. Everyone can see me, right? It's not my signal. I'm not just sitting here on my own, am I? Right, Helen, we'll try and bring you back in. Wait there, 2 secs. No. Sorry, guys. Technical glitch. We love a technical glitch. So the only person that wants to let me allow in is Julie Simpson. Julie, do you want to go live for unplanned? What is Facebook doing? Come on, be nice to me. One day I'll do one of these and there won't be a technical glitch. I don't know, this is very odd. Sorry, guys. Aha, right. I've got an option to bring her back in. Let's see what this does. Helen, I'm trying to bring you back in now, if you're there. Ah, good. Matt can see me. Hey, Matt, how are you? I was just looking at your Facebook profile about 15 minutes ago, funnily enough. Nice to see you. Helen, are you there? Where are you? Interesting. Now, my signal's saying full signal. Let me unplug my charger. Maybe that's killing it. It shouldn't be, but I'm clutching at options. Let's add you back in, Helen. Right, it says you're adding. Are you there?
Ah.
Yay! Is that
I
your
was just
signal?
about to phone a friend to see if they could help.
I don't know.
I don't know what happened there.
Let's try it. No worries. So, you were saying that limited company is probably the most tax efficient vehicle for buying houses, but there is very much a personal circumstances rule that applies to that, and so you should just get good advice, right?
Yeah, that's right. And also for those who may have properties in their own name and then start to buy properties in a limited company, because the way Section 24 works, they, you know, if they are just taking, as most sort of owner managed businesses will do, if they are just taking small salary and the balance by way of dividend, they may actually find that they don't get the full Section 24 relief. You know, you're thinking, oh, well, we'll get the 20%, but because the way the rules work, they may actually not get that full 20% in the tax year. So it is critical that they take proper advice on this.
So actually, all those people that are saying it's definitely got to be a limited company, what you're saying is, unless you've got a big enough portfolio and you're paying yourself a big enough amount of money, actually it might cost you more money to go into limited than actually save you.
Yeah, that's right. Because,
Wow.
I mean, for people, I mean, if you're looking, limited companies are fantastic. If you are looking to build up a decent sized portfolio, you don't necessarily need that money to live on. So, and because companies pay corporation tax at just 19%, if you are looking to build up your portfolio, you'll probably get there a lot quicker in a limited company than just in your own name. But if you're only going to be buying 1 or 2 properties, you do need that money to live on, then actually, because companies cost money, accountants like to charge you more fees for a limited company than if you just own the properties yourself. So, if you are in that circumstance, it's easier, it's simpler, and maybe cheaper to just continue to buy them in your own name. And also, because of the interaction of the tax, because the way Section 24 works, if you have got properties in your own name and then you're looking at a limited company alongside that, you just need to be careful how you take any money out of that limited company, because you may actually find that you don't get the full loan interest relief.
Okay, good advice. I mean, you're starting to blow my mind with technical stuff, because it does blow my mind. But I think the point is that everyone definitely needs to get advice on that. It's not as simple as just, buy your houses in a limited company.
Yeah.
So, okay, cool. And the next question on my list that I had is for the budding developers out there and the people that are let's do it one at a time. The people that are raising funds through JV partnerships, working with other investors to fund their property deals.
Yeah.
From a tax perspective, from an accounting perspective, generally the feeling in the industry is that creating a SPV, so a special purpose vehicle, for the money and the land and the bits to all be gifted into is the most efficient way to do that. Is that right in your opinion? Is that wrong? Is there anything to be aware of or be cautious of in that sort of situation?
I would generally advise to go down the limited company route, because you get the limited liability protection, which is a very good thing for limited companies. And most of my developers, where they are entering into JVs, are going down the limited company route, and also possibly owning, having their own limited company which owns the shares in that SPV rather than owning them directly. Because if you want to take the money out of that business and then invest it in another company with someone else, having your investment held within another limited company, you can take that money out and pass it up to your limited company by way of dividend, tax free. Whereas if that money comes into your own hands to then be reinvested into your next JV, you're going to pay tax on it. So using groups of companies or something like that, or having, the alternative is to have limited companies but side by side, where they can make loans between the two limited companies. But you definitely, I would say almost certainly a limited company.
Okay, so if I'm going to do, just to make it tangible and so that I understand it, and hopefully everyone else this will help. If I'm doing a project and I've got an investor putting the money in, I'm putting the work in, and a vendor's putting the site in, so it becomes basically the ownership of the money, the building, and the time. It's better for the money to come to a separate limited company, so my limited company that I own here, rather than to me personally, the profits, because otherwise I'll pay personal tax liability on the profits rather than it being able to be moved around between my limited companies.
That's right. Yes. Yeah.
Amazing. Wow, that's very helpful. That could save someone a fortune. Like, imagine you had like a £500,000 profit and you took it yourself rather than moved it into another loan for another business. That potentially saves thousands and thousands. That's amazing. Okay, cool. So next question I have is, Okay, it says, hi, Helen. I'm not sure who this is from, but it's quite a good question. I'm looking at how I can more effectively arrange my portfolio to mitigate inheritance tax. Someone has mentioned a trust. I've got properties in and out of limited company. What's the best things for me to think about?
And trusts are very inheritance tax efficient, because assets within a trust are, if it's the right type of trust, don't fall in anybody's estate for inheritance tax purposes. So they come with huge inheritance tax benefits, but because of that, there are other tax consequences. So if there's income arising in a trust, it always pays tax at the height of income tax, so 45%, and capital gains tax at 28%. There is inheritance tax consequences potentially when you transfer assets into a trust during the lifetime of a trust, and when you transfer assets outside of trust. So they can be quite expensive, but they also, I say, come with these fantastic inheritance tax benefits. So in the right circumstances, trusts are great. But they, you have to know all of the pros and cons. In addition, there are trusts. So there's what's known as employee benefit trusts. So a company can set up a trust for the benefit of its employees. And where you've got a property business, well, property company, should I say, what some people are doing is using employee benefit trusts to transfer their shares in the company to the employee benefit trust for the benefit of future employees who are basically their family. But employee benefit trusts come with fantastic inheritance tax benefits in the fact that, again, there's no real tax consequence from setting up an employee benefit trust if structured right and with the right assets, but they can be passed down the generations inheritance tax free.
So what's the difference between that and, so I was given some advice, which is just to make, if I had children, for example, just to make my children directors of my limited company, so that if I died, they effectively just absorb the company